Good morning, video morning brief for the U.S. stock market. I'm Rich Pass for Critical Point, Friday, February 28, 3:36 a.m. Eastern Time. 8:36 a.m. Eastern Time. Okay, just got the PCE inflation report. That is more watched by the Federal Reserve than the CPI inflation report. And it was about as expected, 2.6%. The market's kind of, so what? Futures were up about 18, 20 points here a moment ago for the S&P 500. So not much out of this inflation report. There's news of stagflation worries now and even stagnation for the economy. It's becoming fashionable to worry and to calculate and to forecast bad times coming. Trump on March 4th will increase tariffs by 10% to China and is going to follow through on the Canada-Mexico tariffs. Now, something could change over the weekend, of course, but I think the market is saying, no, it is what it is. It's going to happen, and take it from there. Now, there's also news that Trump's people, Treasury, the Treasury is trying to lower interest rates on their own and not mess or bother with the Federal Reserve. Apparently that's working in the bond market, but I think that's just, it looks that way and not really what's going on. I think the bond market is worried about recession, bad economic times coming here. Things are deteriorating quickly, okay? But it could be something like that. And then there's also discussion that that the Trump people, Republicans, might be wrong on trying to persuade interest rates to go lower. The way they're going to do it could backfire. All right, so let's keep some eyes on all of that information. And I do have some more information towards the end. Let's see where we're going for today and next week at least. All right, this is the S&P 500 hourly cash, and it did fill the gap from January 15th. So good, got that over and done with. But it closed on the lows of the day. It looked really ugly yesterday, and I'd be concerned it might want to go down to this bullish head and shoulders pattern and the lowest price of January. It might want to head down to 5,800 near term here. Interest rates as of this morning, they're trying to pick their head up. It's very late. It looks like we ought to have interest rates higher next week, okay? Bitcoin crashing and burning, and it can be weak now all the way into summer. It's due for a long-term bottom. It's coming down. That could be problematic. The dollars actually has been helping out, trying to turn up from a bottom as forecast, so I like it so far. Don't know what it really means for the stock market right now. I think the stock market really is not that interested in what's going on with interest rates, unless they're going down, and it gets nervous about a bad economy. Instead, it's looking at what's going on with its own business. So what's going on with its own business? Well, this is the 6-hour chart of futures, and the model is showing yet another alternative forecast, meaning people are really breaking up. They're coming up with multiple tactics and strategies and forecasts where we're going. There is a possibility the market bottomed yesterday, latest allowed by one model script. If it goes lower today, and if it trades below the low of yesterday, cash and futures, specifically all three markets, or better still, all three markets, Dow Jones, NASDAQ, S&P 500, I think that's too late, and the model's going to say you better assume lower next week as well. It's going to readjust these level threes. Now, it's still going to forecast a bounce next week, and maybe even a bounce from today into next week. And since we got this rather neutral inflation report, I'm thinking at least that's one less thing. Just maybe somebody will put this higher today, because regardless if this is a level 3 bottom or not, as of yesterday or overnight, should be a level 4 bottom, and it revised yet again. It flipped back. It had the level 4 there, then it put it there, and then when it broke below yesterday, it said, oops, you got to put it back there, and now start looking for it again, okay, the next one. And it's saying it really ought to wrap it up today. Now, the cash mark, so we can get a little weakness early today, but it ought to be higher by the end of the day. If it's not, that's not a good sign, okay? Because weakness today could be a sign it's going to be weak Sunday night, Monday, and it might be really weak, okay? There's things here I don't like personally that the model really can't, I don't know the math to make it figure it out. we could be in something like a miniature 1987 crash. We could be in a miniature 2020 crash, okay? There's other periods of times where you can just see it could be intense. This could be a down move first half March, and even though it shouldn't bottom to late March, April for those larger trends, we might get the worst out of the way, or March is just a bad month, period, okay? So the next thing we want to consider is the level 3 top is due next week. What I'm trying to explain, and I'm not doing very good at it, I'm concerned that level 3 top will just be a tiny little blip up, won't be noticeable, wasn't useful, didn't work, okay? And it's just buried inside a more intense downtrend. But ideally, the market's going higher next week, okay? And I don't think it's going to 6,100. I'm leaving that target. That's still the maximum. But I'm concerned that they might start selling it around 59.50 futures. Cash may be a little bit lower than that because of the premium to futures. They might be able to push it to 6,000. I don't think it's going to strike 60.50 next week. I'm just concerned it's going to be like a 1 or 2 day blip up, and that's it for level 3. It's just down, 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 okay? Now, working against me on this is everything on a short-term to extreme short-term basis oversold. Technical-wise, it ought to bounce. Somebody ought to be doing some shopping here. I don't like buying this level 3. I don't think it's going to be really worth it. I want to sell level 3s for more downside, but I'm nervous of missing out that it's just not going to blip up enough. The model won't catch it fast enough to sell it for more downside. So at any rate, the idea forecast is up next week for level 3, down by the following week, and could be down some of next week. And then the less ideal forecast, the one that's a bit problem, is that it's really hardly going to blip up at all. People want to just keep selling, all right? So hopefully that makes some sense. You can put some use to it. Let's go to the S&P 500 cash. Big down day yesterday. I didn't mind it being down, but it was down more than I thought. I made a quick little day trade, got out too soon, but I made some money. But I'm getting out too soon on my downside. I need to have some and just set on it for a while and see how much I can really make, okay? Any rate, had problems with the 100-day, 50, and 40-day moving averages. If it bounced back to that, I think they're probably going to sell it later. And I think that's probably the maximum they're going to go. But it should give us a blip up into next week. This is not a price target necessarily. It's just giving us an idea. It can go up and then down. That's how the supply, demand, buyers, sellers are going to work it. This is saying this is so oversold. Yes, it should bounce. Even if it's going lower later, it should bounce something, kind of reset. But here's my concerns. They tried to bounce it on those moving averages, couldn't get it done. They gave up. They gave up to fill this gap, so maybe they're going to be happy-dappy now, fill the gap, put it up. But I'm nervous that they might say, well, let's put it down to 5,800 lower to the January low, the low of the year. All right? And they're not going to like to hear that statistic that it's back to the low of the year this time of year. And then maybe they'll bounce it again and bump its head. It could also get very sloppy and difficult for it. But overall, I think they're saying if you can't find support here at this gap and these moving averages, you might as well just slam dunk it right down to 57.16, the 200-day moving average. Now, it's so oversold, it's saying, well, it should not do that, but look at yesterday how much they sold it, and the indicator didn't even budge. It was oversold. This type of indicator, and this happens to all people in the markets using indicators, sometimes it gets so oversold they can't respond. The market just keeps on crashing. It's a breakdown market, and I really am concerned of that kind of behavior here. All right, next up, I want to take a look at the Dow Jones. Now, the Dow Jones yesterday, I thought to myself, boy, this is probably a sale, and I was even going to sell it, and then I didn't, but I was selling some other stuff, but then I got out of it. Same problem. They hesitated, saying, is this a floor price at these averages going higher? Well, they gave up yesterday, saying, I guess not. And this is relatively stronger. I thought it had been the weaker one, but really it's a relatively stronger one compared to NASDAQ S&P 500. It still has a gap to fill. I think it's going to 42.50. And the question is, does it do it 5, 10, 12 days from now because it needs to blip first for level 3? Or is it going to do it now into next week? And I'm more concerned of now. Even though it's oversold and really shouldn't do it, I'm afraid it's one of those markets where people don't care whether they're doing anything right. They're just selling and then asking questions later. That's the mood. Risk off, just sell it, okay? Now, The Dow Jones, I can come up with something a little different, that maybe that's a level 3 top. That's a level, actually I can extend it out to here, that this is a level 3 top. A few days ahead of the S&P 500 and maybe the NASDAQ. In a way, the Dow Jones shown relative strength, but it's actually pattern-wise leading the market lower. It's already bearish. Should have been sold yesterday, is how I look at it. And the model is this morning kind of flashing a red light here saying, yeah, I think you could sell this and forget about that level 3 rally for the Dow Jones. Now the question is the NASDAQ and the S&P 500 on the same page? This is the NASDAQ, and they're trying to turn it around this morning. This is delayed pricing, so I don't know how they're dealing with the inflation report right now. But it should bounce into next week for level 3. And it can stay up all of next week, even in the early following, but it's probably topping sooner rather than later. I just don't trust it. But at least this one's close to its 200-day moving average, and it's quite oversold. Maybe this one can bounce better and lead the S&P 500 up, and maybe even the Dow. And that's the way it's actually been working a little bit intraday. It looks like when they decided to buy the NASDAQ, they put it up a little faster. But boy, when they tried to sell it, they put it down a little faster than the rest of the market, okay? What else can I show you? That's the NASDAQ. Let's go to the equal weighted index, and it just looks ugly, okay? And I'm just concerned it's down into next week. It's not really going to pick its head up. That's another problem, is it could be down into early next week, bounce for that level 3, but by the time it bounces, we're going to say, so what? It's so low that it really wasn't worth it, and it's just going lower later anyways. This is the S&P 500 futures with model analysis. In theory, it shouldn't bottom to next week, bounce next week, maybe a little later, and down yet again. But the model's saying there's a scenario and it can bottom today. Should have bottomed yesterday, latest allowed, in fact. Now I'm coming up with a different scenario that it's next week, okay? I'm nervous that if this turns down today, we better get serious about it. It's going to be lower next week first, move it, bounce a little bit, then lower still. The level 3 won't matter that much to the upside, that it just wants to go lower, lower, lower. That's the blend of all these scenarios. And why do we have so many scenarios, model scripts? It's because people are doing the same thing. They're looking at 3 or 4, 5, 6 different ways of doing things, and they're just trying to simplify and come up with a bias. And right at the moment, that bias is risk off, just sell it. Don't play games with it. Sell first, just get out, throw your hands up, and forget about it, okay? Let's move to the weekly now. Quick little, I realize this should just be a morning brief and just very short term. Ugly chart on the weekly. S&P 500 brought it back to fair valuation. I've been saying all along it ought to go below fair valuation, get it undervalued, get it cheap. Very bearish acting indicator. It can bottom at mid-range and turn up, but it's kind of rare to do that. I think that's saying this thing's going lower the next 1 to 3 months, or it should. That's the bias. Now, get a gold star for the downside target was already met, but it's met ahead of schedule. There's more of that downside target down to 58.17, but I got many downside targets. This thing can just crash and burn, go all the way down to the August bottom, and could go down to the pre-election bottom or election day bottom. It can go down to the January low and then bottom. Okay, I'm not going to talk about the farther out long-term stuff. All I'm telling you is this market should go lower into late March, early April, and bounce some. And then we'll reevaluate whether that's a long-term bottom or not so important bottom, whatever. I'm also warning you, though, they might crash and burn this market and get the lowest price ahead of the bottom, but it shouldn't rally much until that bottom is put in place. Keep writing this stuff down. Keep track of it. It also can get most of the downside out of the way, and it's just a little bit lower by late March, April. This thing's falling apart, in my opinion. I'm really concerned at it. But it is going to put in a level 3 top next week. But the problem is it may be so weak that it's just a 2-day blip up, barely noticeable. The model will peg it for timing purposes, but it's useless information for you and I. I am concerned of that. I'm warning you of that. You want to be more bullish, optimistic, go for it, because it is due to bounce. It's been beat up enough. I just don't trust it. I'm afraid they got a lot more beating to do here. Knock this market down. All right, I'm trying to follow my timer here and see I'm getting carried away in my time. Getting weaker in the percent stocks over the 200-day average, okay? All the other indexes look weak to me, and even the equal weighted index of the S&P 500 looks weak to me. The VIX is moving up. It can move up more, meaning the stock market can move down. Next up, we want to go to the interest rates, if I can find it. And this doesn't have to, it looks ugly. They're betting more on a recession than they're betting on inflation. They may even be betting on an inflationary recession, but feel the need that rates would go lower. They really are worried where all this tariffs, Trump, and stagflation. Go look at Bloomberg News, Headline News, CNBC, Market Watch. You can see all the reporting there of some of these things they are worried about, okay? Okay, if you're not interested in fundamental stuff and chit chat, we're done for the day. Just assume, yeah, I should pick its head up next week, but I really am nervous. This is a crash and burn market. All right, stay focused on that late March, April bottom. It ought to go down into it. All right, have a great weekend. Any rate, let's go look at the credit cards. This is not looking good to me. This is kind of like a half business cycle of the juggler business cycle. This is the true juggler business cycle, the once a decade, sell the economy, sell the stock market. Okay, again, buy it. Okay, buy it. But this, look at how high this is. Where are we going by the end of this decade? That should not top out to late this decade. Well, my guess is we've got a problem now. In the next year or two, that'll back off. And it may not go as high by late decade, but it can give us another problem late decade. But right the moment, this is a warning. We could be heading for a secondary recession, 2025, 2027. We really haven't seen those since the 1980s. More likely, 1970s on into the 1800s, maybe even more likely 1950s into the 1800s, okay? Secondary recessions occur about mid-decade. They most frequently are not called recessions by the government, Federal Reserve, by economists in general, okay? They just slip under the radar screen. But to the American people, for some people, it was nearly as severe as a recession. And for some sectors, it can be an actual recession. A little bit concerning where we're going with that. Okay, this is from Stephanie Kelton on MMT. And I would like to point out that really what it's suggesting, if the MAGA people, MAGAnomics, the Treasury, Trump do what they want to do, they may actually be starving the private sector, that what these this black and these reds are going to come closer to zero here. We're taking the surplus out of the private sector. It's like we're going to starve the middle class and poor to grow. They're trying to limit the money so it doesn't, that they're not printing money is really what they're doing. And they call that real growth, and they basically lie about it. It's propaganda. Real growth means low GDP growth for the middle class and poor. It's that simple. It's another tactic, a different twist on the let the rich get richer, the trickle-down economics. This can be self-destructive. This leads to recessions. Let me click on the next one. Somewheres I think it discusses this. I have 3 of these, but they might just be telling the same. Here's one talking about recessions setting up. You may want to do some searches and look at that. This is another one to look at with Clinton. Clinton did the best job. Hey, he did do some of the Republican stuff, and then he did some of the Democrats, and then both of them didn't like him. Okay, so but he pulled it off. All right, I have some interesting stories about that of people that actually worked with Clinton that I had conversations with. Fascinating stuff. All right, at any rate, let's go to the unemployment, or this is initial jobless claims, and the model is saying this is actually a level 1 pad, and pleased to see this. It's some fundamental data won't show that like the stock market will. This could be a level 1 where it backs off in the next month or two, but it's probably going to be higher by summer, unfortunately. But because we're just hammering the creating unemployment in the government, it can be like an austerity thing that trickles into the rest of the economy. I'm concerned the level 1 was right there, okay? And we got a brand new level 1. I think this could go up even faster going into summer months, or at least into May, okay? So this can scare people. I think when you look on a long-term basis, it's not that big a deal yet, okay? But it's something to watch. People are just creating a bigger, greater and greater list of problems and complications, okay? Quick chart on what's going on in states, and we're going to see more battles. This is where some of these states are going to get tired of pumping money out there to basically provide welfare for the people who are causing all these problems in politics and Wall Street, okay? Simple as that. All right, that's probably it for today. Okay, so the inflation report came in at 2.6 on the PCE, kind of neutral. I think the market should bounce here, but I'm just nervous of more and more downside here. This might be a bit tricky for me on a short-term basis, keeping up with it, and just giving you that warning. Past results and unnecessary indicative future results. Have a great day. Thank you.